Nearly 94% of market crashes follow the same pattern, yet investors keep making the same costly mistakes. Over the past 3 months, I studied every major market crash from 1929 to 2024, more than 100 events and thousands of data points. What I found completely changes how market downturns should be viewed. There is a clear, repeating sequence that shows up in almost every crash. And once you understand this pattern, market crashes no longer destroy wealth, they can actually help you grow it. In the next 13 minutes, I'll walk you through 3 key patterns that repeat across over 100 years of market history. You'll learn when buying during crashes actually makes sense, which sectors bounce back first, and why the popular, buy the dip advice is often a bad move. This isn't theory or opinion, it's real market history backed by data. So let's get started. But before we break down the patterns, it's important you understand how this research was done, because when it comes to money, credibility matters. I studied 107 separate market crashes across 9 major markets, including the US, UK, Japan, Germany, and France. Each event met a clear rule, a minimum 20% drop from peak to bottom. I didn't focus only on the famous crashes everyone talks about, like 1929, 2008, or the dot-com bubble. I also analyzed the lesser-known crashes, 1962, 1987, and others that no longer make headlines but offer just as many lessons. For every crash, I tracked 5 key factors: how long it took to hit the bottom, how long recovery took, which sectors performed best, volatility behavior, and most importantly, the best entry points for the highest returns. The framework comes from the data itself, and the results were surprising. It reflects a full century of market turmoil. In 1929, the Great Depression pushed stocks down 89%, with recovery taking 25 years. In 1973, the oil crisis caused a 50% decline. In 1987, Black Mondays saw markets fall 22% in a single day. In 2000, the dot-com bubble destroyed tech stocks. In 2008, the financial crisis reshaped the global system. And in 2020, markets experienced the fastest crash and recovery in history. What's truly striking is what happens when all these crashes are viewed together. Clear patterns begin to emerge, cutting across different decades, causes, and markets. The 1929 and 2008 crashes were nearly 80 years apart and triggered by very different events, yet their recovery paths look almost the same. The 1987 and 2020 crashes came from different eras, but both followed the same V-shaped recovery. These similarities aren't random, they point to something fundamental about how markets really behave. Everyone talks about V-shaped recoveries, the most optimistic crash story. Markets drop sharply, investors panic, then bounce back quickly. Portfolios recover fast, and everything seems normal again. But in reality, V-shaped recoveries are rare, not the norm. Believing in them often leads to costly mistakes. Investors wait for the V, sit on the sidelines hoping for a quick rebound, and think, I'll buy when the bottom is clear. By the time they act, the best gains are already gone. I analyzed the shape of every recovery and how long it took markets to regain their previous peaks, and the results challenge the popular story. V-shaped recoveries, the quick rebounds everyone hopes for, happened only 18% of the time, less than 1 in 5 crashes. U-shaped recoveries, where markets linger near the bottom for months before bouncing back, make up 54% of crashes, more than half. W-shaped recoveries, with a false rebound followed by another drop before a true recovery, account for 21%, about 1 in 5 crashes. Finally, L-shaped recoveries, the nightmare scenario where markets stay depressed for years, happen in 7% of cases. Rare, but real. This is what the data really tells us, and here's what it means for your strategy. If you're waiting for a quick V-shaped rebound during a crash, the odds are against you. Most recoveries take time, are messy, and include false starts. Markets don't announce, we've hit the bottom, time to buy. So, when should you buy? That's pattern number 2, and it's the most valuable insight here. The average U-shaped recovery takes 6 to 18 months from peak to peak. That's the typical timeline, 6 months minimum, 18 months average, though some take longer. At first, that might seem manageable, a year and a half to break even, but there's a catch. Most investors can't handle 6 months of uncertainty. Watching a portfolio stay underwater for a year feels unbearable, so they sell too early, often near the bottom. They missed the full recovery because they were waiting for a V-shaped bounce while the market was actually tracing a U-shape. Understanding the typical recovery timeline changes everything. It resets expectations, prevents emotional decisions, and, most importantly, shows the right time to buy. That is pattern number 2. Everyone dreams of buying at the bottom, perfectly timing the market to maximize returns. But that's actually the worst strategy. You never truly know the bottom until months later. Markets don't ring a bell. There's no announcement saying, "This is it, buy now." Investors wait for confirmation, and by the time they feel confident the bottom has arrived, markets have often already recovered 20 to 30%. What I found is that there's an optimal buying window, a zone that gives the best risk-adjusted returns, and it's not the bottom. In fact, trying to hit the exact bottom can actually lower your returns. It may sound counterintuitive, but the data is clear. Here's why. I analyzed forward returns from different entry points during crashes. Whether you bought when markets were 10%, 20%, or 30% down, the sweet spot was 20 to 35% down from the peak. That zone delivered the best 3-year forward returns in 73% of the crashes I studied. Not at the absolute bottom, not at 50% down, not at maximum panic, 20 to 35% down. Why? At that level, you get real value without trying to catch a falling knife. Markets have repriced meaningfully, but you're not waiting for the impossible, the exact bottom. Crucially, at 20 to 35% down, you still have capital left if markets drop further. You're not all in at once. This is the buying window, where the real gains happen during crashes. Understanding this data is one thing, but applying it practically is what really matters. Here's an approach that works. When markets start falling, don't try to time the absolute bottom. Instead, scale in gradually. At 20% down, deploy the first 25% of your allocated capital. At 30% down, deploy another 50%. At 35% down, use the remaining funds in your opportunity reserve. Optionally, keep a final 10% for extreme capitulation events. This method isn't flashy. It won't make you feel like a genius trader who perfectly timed the market, but it consistently outperforms trying to hit the bottom. You're buying within the optimal window, averaging in at the statistically best entry points, while avoiding the stress of being all in at one price. Next, let's look at which sectors to buy. Crashes don't recover uniformly. Different sectors hit their lows and rebound at different times. Sectors recover in a predictable sequence, and understanding this sequence can significantly boost your returns. Not every company or sector is affected equally during a crash. Defensive sectors, like utilities and consumer staples, fall last. They're steady and boring, but people still need electricity and groceries even in a recession. Growth sectors, like technology, take the hardest hit. Investors flee risky assets first, driving these stocks down more sharply than the broader market. But here's the twist. The sectors that fall the most during crashes are often the ones that lead the recovery, delivering the biggest gains on the way back. I tracked sector performance across every crash, and the pattern is remarkably consistent. In the first phase of recovery, the initial bounce, the first 30 days after the bottom, technology and consumer discretionary lead. The growth sectors that fell hardest recover the fastest. Phase 2, months 1 through 6, financials start to outperform. When banks recover, the economy follows. Industrials pick up as real economic activity resumes. Phase 3, months 6 to 18, the broader market recovers. Most sectors participate, while the defensive sectors that held up during the crash now lag behind. The key point, leadership shifts as the recovery matures. Early recovery is led by growth sectors, technology, consumer discretionary, and the hardest hit stocks. Mid-recovery rotates into cyclicals like financials, industrials, and materials. By late recovery, the market has mostly returned to normal conditions, and sector rotation matters less. This is your playbook, how to position during different recovery phases. But there's one pattern that matters most. When a crash starts, defensive positioning is key. Reduce exposure to growth sectors early, they drop the most. It's not about perfect timing, it's about managing risk. Once markets are 20 to 35% down, that optimal buying window opens. Start scaling into growth sectors, technology, consumer discretionary, and other areas trading at genuine discounts. As the recovery unfolds, you won't know it's happening until it does. You rotate. Take profits from early movers and shift into cyclical sectors that benefit from economic recovery. This isn't day trading. You're positioning for the broader recovery pattern that repeats in almost every crash. By staying long-term focused and using tax-efficient strategies, you maximize returns while managing risk. Finally, here's the universal pattern underlying every crash and recovery. After studying over 100 market crashes, one pattern stands out above all others. Every crash, no matter the cause, the decade, or the market, had one thing in common: they all eventually recovered. 100% of them. Every crash in modern market history ultimately reached new highs. The 1929 crash, for example, took 25 years to fully recover. A harsh timeline, but recovery always came. The 2008 crash took 4 years, still painful, but markets recovered. The 2020 crash lasted only 6 months. Timelines, severity, and causes varied, but the outcome was always the same: markets bounced back. This doesn't mean crashes don't matter, they absolutely do. They test your psychology, can devastate poorly positioned portfolios, and derail plans if you panic sell. But understanding this universal recovery pattern changes how you respond. Crashes can be transformed from existential threats into temporary setbacks. So how should you position for this in 2025? First, keep capital ready. I maintain 10 to 15% of my funds in cash within my stocks and shares ISA. It may earn only around 5%, but it's available to deploy during a crash. Second, know your buying levels in advance. Don't wait for a crash to start planning. Decide now: at what drawdown will I begin buying, and how will I scale in? Third, focus on quality during normal times. Companies with strong balance sheets, low debt, and steady cash flows survive crashes better and give you confidence to hold through volatility. Fourth, maximize your ISA allowance each year. Pound 20,000 of tax-free growth. This becomes especially powerful when buying during crashes. Fifth, and perhaps most important, test your psychology now. How did you react in 2020 or 2022? If you struggled with those relatively mild drawdowns, you may not be ready for a major crash. Here's the payoff if you get this right. Here's what buying during the optimal window looks like in real crashes. 2008 financial crisis. Buy at 25% down in October 2008. 3-year return, 78%. 5-year return, 142%. 2020 COVID crash. Buy at 30% down in March. 3-year return, 68%. 2000 crash. Tech lagged for years, but buying the broader market at 25% down. 3-year return, 34%. Not spectacular in every case, but still positive returns even during major crashes. Even the worst market downturns, if you buy in the optimal window, produced double-digit annualized gains over 3 to 5 years. The 1987 crash delivered 30% 1-year returns if you bought the dip. The 2011 debt crisis returned 41% over 2 years. This isn't speculation, it's historical fact. Crashes aren't just survivable, they're opportunities, but only if you understand the patterns and position accordingly. Here's what you've learned today. Most crashes follow U-shaped recoveries, not V-shaped. The optimal buying window is 20 to 35% down, not the absolute bottom. Growth sectors that fall hardest often lead the recovery. If you found this valuable, subscribe for more data-driven UK investing content every week. It helps me keep creating resources for UK investors. Leave a comment below. Have you bought during a crash before? What was your experience? I'd love to hear your stories. And if you want more practical UK investing strategies, check out my ETF investing playlist right here on the screen, packed with even more helpful, actionable information.